This is Chapter 17, Section 3, Measuring the Value of Trade. As we go through today's information, I would recommend that you take notes so you'll have the information for the check for understanding at the end of the lesson, as well as for your test and eventually the exam. So we've been talking about international trade, and today we're going to focus on exchange rates. So how do we know what the value of money is in each country and what determines that? And we know what our money, as we value it, we may not know how it compares to other currencies. So the first thing we talk about is the foreign exchange market. This is a market in which currencies of different countries are bought and sold. This is a network of major commercial and investment banks that link the economies of the world. So if you hear about, an exchange rate between the US dollar and the euro or the pound or the yen or whatever the case may be, it's not just a random number. These numbers are determined by the value of that currency based on these this market of buying and selling the currency. Okay, so different factors involved in the foreign exchange market. There are central banks of different countries. This is supposed to say companies. I don't know why it's misspelled. Individuals, brokers, commercial banks, and institutional investors. So all 6 of these play a role in the exchange market. And so one by itself is not going to determine the value of a country's currency, but together they all work to determine those things. And so if one currency appears to be more valuable than another, then that would obviously increase their exchange rate. So one thing I also want to point out, and we'll talk about this in a little bit, is that at one point in our nation's history, our money was backed by gold. But we no longer follow that standard, and a lot of our money has no backing at all. So the money we have has value because we say it has value, not because it actually has anything to back it up, at least to a certain extent. So foreign exchange rate, this is the price of a currency in the currencies of other nations. And so this is an image here of the exchange rates within that market we were just talking about, the exchange market. Again, the numbers are not completely random. They are based on how the currency there is valued, and we'll talk about what kind of determines the value in a moment. But you need to know that exchange rate is basically how many euros do you get for every US dollar? Or how many yen do you get for every US dollar? Or how many pesos do you get for every US dollar? So that would be your exchange rate. How much does it cost you, and how much does it cost them for that same amount of money? So things that affect exchange rates. Inflation, a country's inflation. So if they're printing off a ton of money at one time, the more money in the market, the less value it holds. And so that obviously would affect the exchange rate. Interest rates, depending on what those look like in a country, could have an impact on the value of the currency. Public debts, so that's not only the country's debt itself, but also the debt of consumers. Political stability and economic performance. So if you have a country that is frequently changing their leader and changing their type of government, that would not be considered politically stable. And people like to look at consistency, and they're not going to invest in a country that does not show consistency. So if they're constantly changing their form of government, their leaders, or there's any type of hostility happening within that country, that will also decrease the value of their currency. Their terms of trade, so basically how valuable they are among other countries. Are they considered a good trading partner? What resources do they have? Do they have a good history of trade? Things like that. And then finally, current account deficit. So are you spending more than you are bringing in? And then, that taken into account with these other factors would definitely influence how much your currency is worth. So rates of exchange, and here again, we're talking about the history during the 1800s and 1900s. Gold was the standard against which the value of a nation's currency was determined. We just talked about that. And the gold standard was taken away. Nations traded on the basis of a fixed rate of exchange. So basically, how much gold each country did have kind of determined the value of their currency. We don't do that anymore. But a fixed rate of exchange is a system in which the currency of one nation is fixed or constant in relation to other countries. And we know that that's not accurate anymore. Currencies' value can change day to day based on what their economy is doing. So this is something that's kind of, in the past at this point. And it used to be a way in which we could measure the value of our currency compared to others, but we don't use that gold standard anymore. And so now we have to use this exchange market and the calculations that they take into account when looking at the different factors. In the 1970s, the U.S. ran up a trade deficit and the dollar declined in value, and the flexible rate of exchange, also called the floating rate, became predominant. So a flexible rate of exchange or a floating rate is a system in which the exchange rate for currency changes as supply and demand for the currency changes. And so just make sure you know that definition. It's not something we talk about a whole lot, but I would definitely make sure that it's something you're familiar with. So how do we calculate exchange rates? Where do we come up with these numbers? So the amount of the currency you want to buy times the exchange rate equals the cost in currency you have. Okay. And really, if you don't want to do the calculation, if you're traveling to another country, it's very simple to look, you can just Google search what's the exchange rate. And it will automatically come up, or you can even look at multiple exchange rates at the same time. This is not necessarily a equation that I'm going to expect you to know. I just want you to know, where do we get this from? How do we know this number? All right, so let's talk about strong versus weak currencies. The Federal Reserve keeps a measure of the international value of the dollar called the trade-weighted value of the dollar. That's a measure of the international value, which I was just saying. And how does the trade-weighted value of the dollar affect trade? And so obviously, if our dollar is very valuable, other countries really want to trade with us. But if the value decreases, we don't see as much as a good trading partner. Okay, and this is just demonstrating kind of how that has changed over time for the trade-rated value of the dollar. Balance of trade, the difference between the value of imports and exports of a nation. Balance of trade is calculated through the balance of payments, so a record of all the transactions that occurred between individuals, businesses, and government units of one nation and those of the rest of the world. It's important to try to have a balance of trade because that shows that you are important to other nations and that they are important to you. If you don't have that balance and you are importing more than you are exporting, then you're not seen as valuable to other countries. And if you're exporting more than you are importing, then you probably are not very efficient because you're probably having to create a lot of your own goods and services. So having that balance is really important, and it's really important in your exchange rates as well. So a trade surplus, this is what I was talking about, is a nation exports more than it imports. And a trade deficit is a nation imports more than it exports. Neither of these is very good. I know it says which one is better, but neither one's very good. I would say if you were to pick one, maybe surplus, depending on how much of a surplus you actually have. But remember that a surplus, if you're unable to sell your products, all of your products, that is inefficient. And it is not effective. It's not good for economies to be inefficient. So both of these can be negative, even though surplus sounds like it might be a positive thing. Okay, so this is showing us kind of where we stand. Obviously, it's a bit dated, 2018, but trade deficit in billions, and it's seasonally adjusted. Remember, seasons do matter. Certain seasons you might sell more of something or less. And so you can see the trade deficit has kind of continued to tick back up after we saw a decline back in 2018.